welcome back to The Deep Dive, your shortcut to truly understanding the forces shaping our world. Today, we're plunging right into the core of the technology sector. I mean, this space feels like it's reinventing itself almost daily. We're going to navigate the explosive growth and, frankly, intense competition in AI, and also the complex dance of global trade, how that impacts everything from supply chains to consumer prices, and even how our very relationship with the devices we carry, our phones, is maybe being reimagined. We've looked through the latest reports, analyst notes, executive discussions.
Yeah, absolutely. And our mission here in this deep dive is really to pull out the strategic nuggets from all that noise. It's not just what's happening, but why it matters, especially to you, the listener. We'll get into the colossal investments driving this AI race, the high-stakes talent wars, and, like you said, the evolving geopolitical landscape that's, well, it's redefining global tech manufacturing. Think of it as a comprehensive but hopefully incredibly concise briefing, just trying to get you really well informed on what might be next in tech.
Okay, perfect. Let's unpack this then. When we talk about the tech landscape, we really have to start with the sheer scale. It's almost incomprehensible, the scale of investment in artificial intelligence. It really does feel like a modern-day gold rush, but instead of pickaxes, companies are wielding billions of dollars. We're seeing these hyperscalers, people like Microsoft, Google, pouring just unbelievable amounts of capital into this. So what's the strategic significance of this big money competition beyond just, building better AI models?
It's absolutely foundational. This isn't just R&D anymore, not in the traditional sense. It's more about vertically integrating the entire AI supply chain. You need incredibly deep pockets.
Yep.
And not just to attract the world's top engineering talent, which, believe me, is a battle in itself, but also to acquire the colossal compute power needed. To actually train and deploy these massive models is really a strategic maneuver to try and lock in dominance early on. And we're seeing clear demand signals suggesting this investment is warranted. For instance, Microsoft. They're often a good bellwether, right? They're expected to announce a double-digit percentage increase in their capital expenditure for the next fiscal year. We're talking potentially pushing north of $100 billion.
Wow. $100 billion.
That figure alone should tell you the magnitude of conviction these giants have in AI right now.
That $100 billion figure is genuinely staggering. Are we seeing signs that this massive investment is already paying off, or is this still very much a speculative bet on future returns?
It's a bit of both, I'd say. While, yes, the biggest payoffs are probably still down the road, there's definitely clear traction happening now. These companies aren't just building for themselves. They're building the infrastructure that pretty much everyone else is going to need. And here's where it gets really interesting. It's not just about who builds the best AI models, but where they actually live and run. The cloud computing aspect is absolutely central.
Right, the cloud. So how are the major cloud providers positioned? We're talking Amazon's AWS, Microsoft Azure, Google Cloud, maybe even Oracle. How are they set up to capitalize on this AI boom? It sounds like they're the ones laying the tracks for this gold rush.
Precisely. That's a great analogy. AWS, Azure, GCP, and Oracle Cloud Infrastructure too. They are all incredibly well positioned to ride this tidal wave of AI spending. Think about it. As enterprises, both large and small, deploy AI tools and applications, they overwhelmingly do it on these cloud platforms. That drives massive demand for the underlying infrastructure, servers, networking, everything, and of course a huge, kind of irreplaceable part of that infrastructure.
Yeah.
Well, it's the chips themselves.
Okay, chips. So NVIDIA comes into play here.
Absolutely. NVIDIA, for example, they maintain an exceptionally strong competitive position with their GPU chips. They just unveiled Blackwell Ultra last week, actually. It's designed for, unprecedented speed and energy efficiency. That makes it an incredibly compelling product for both enterprises and those hyperscalers we mentioned to integrate into their data centers. It really is a foundational piece of this whole AI puzzle.
Okay, so given this enormous investment, the cloud infrastructure, the chips, what does all this mean for the broader market outlook, especially for investors looking at tech stocks? Are we looking at sustained growth here, or is there maybe a risk of overexuberance, like a bubble?
That's the big question, isn't it? And while some might argue it feels a bit like past tech bubbles, the underlying dynamics, I think, suggest a more sustained positive outlook, particularly for U.S. stock markets and tech stocks. See, the AI revolution isn't just about speculative investment. It's driving massive inference demand.
Inference demand.
Yeah, that's the real-world deployment and actual usage of these AI tools at scale. The sustained growth in fundamental demand, plus the necessary capital expenditure to support it, actually bodes remarkably well for the sector. We're talking about fundamental shifts in how businesses operate and how technology is consumed. That feels uh, far more robust than just hype.
Interesting. Okay, now let's pivot a bit. Let's talk about Apple, because their story in this AI race feels like a strikingly different narrative compared to those hyperscalers we just discussed. They've always prided themselves on vertical integration, right? Doing everything in-house. Yet in AI, it seems they're taking a unique path.
They certainly are. For many investors, Apple has increasingly been viewed as more of a defensive tech business. A stable giant, yes, but maybe not a dynamic growth engine anymore. And a significant part of that perception stems from their perceived lag in AI capabilities, and perhaps in talent and resources too.
Mm.
They just haven't been leading the charge in generative AI the way some of their peers have.
Yeah, and I found this particularly surprising. Apple, known for being so fiercely independent, their whole proprietary ecosystem, their stock actually jumped, 3 or 4%, just on the news that they were considering using external models like Anthropic and OpenAI for customer interactions. What does that reaction tell us? It seems counterintuitive.
It really is counterintuitive, isn't it? The market actually liked the idea of Apple potentially de-emphasizing its own internal AI research efforts, which frankly has seemed to be struggling a bit. It signaled a crucial shift, I think. Even the most insular tech giants recognize that AI is too foundational, too fast-moving to try and build entirely in-house right now. It's kind of an acknowledgement that they need to adapt or risk falling further behind, despite their incredible ecosystem strength. So this pragmatic approach, even if it means using external innovation, was seen positively by investors.
Okay, pragmatic. But speaking of those internal efforts, this raises a really important question for a company like Apple: talent. We recently heard about a major AI executive leaving Apple, a really foundational figure that must have sent some ripples through the company.
Oh, absolutely. Seismic ripples, I'd imagine. We're talking about Mr. Pang. He was the distinguished engineer and manager of Apple's Foundation Models team. By all accounts, he's regarded as probably the best of the best, the most respected AI engineer and executive at Apple, and frankly, one of the most respected model engineers in the entire AI research community globally. His departure is a massive swing, as big as it is for Meta to successfully recruit him.
Metagata.
Yes, Meta. It's an even bigger loss for Apple. He was, by all accounts, one of the key figures really holding their internal AI efforts together, especially given that, as we mentioned, their AI features and models have been struggling somewhat to keep pace.
And the offer from Meta that lured him away, I heard it was truly staggering. How does a company, even one as wealthy as Apple, compete with something like a multi-year package reportedly worth north of $200 million?
It's an extraordinary sum. Really makes you rethink your career choices, doesn't it?
Ah, yeah.
It paints a very clear picture of Mark Zuckerberg's commitment, almost a singular focus, on winning this AI talent war, seemingly at almost any cost.
And what does that kind of high-profile departure mean for the morale of the team left behind at Apple?
Well, I'm told that more people are likely to follow Mr. Pang out the door from the Apple Foundation Models team. It creates uncertainty. And look, Apple simply doesn't compensate in the same way as an OpenAI or a Meta, especially at these extreme levels. These pay packages are nearing what CEOs of some major public companies earn. It's incredibly difficult for a structured company like Apple to justify that for a single manager or engineer, let alone replicate it across an entire team. Plus, Apple has shown a historical reluctance to make massive counteroffers. When you're facing an offer north of $200 million, honestly, there's often very little a company can realistically do to retain that talent. It's a genuine challenge for them in this hyper-competitive environment.
A huge challenge indeed. Okay, let's shift gears now to something broader, something that affects, every tech company and every consumer: the macro environment, specifically the current trade environment and tariffs. This feels like a huge cloud of uncertainty hanging over the entire industry.
It absolutely is, and it's pervasive. We've seen President Trump's Liberation Day tariffs, for example, introduce a significant cloud of uncertainty. Even if many of these tariffs are still being negotiated or they're kind of on again, off again, the mere threat forces businesses to be extraordinarily cautious. Companies become hesitant about inventory levels, how deep to go on discounts, even where to manufacture things, all to protect their margins from potential future tariffs. This directly impacts big retail events.
Right, like Amazon Prime Day. We saw some really interesting dynamics play out there this year, didn't we? What stood out to you in terms of how companies navigated these pressures during such a critical sales event?
Yeah, Prime Day definitely got off to a bit of a slow start. Spending was down, I think, 14% in the early hours compared to last year. What's also notable is how Amazon extended Prime Day itself. It wasn't just one day. It was 4 days this year. That feels like a strategic response to fierce competition, right?
Hmm.
You had Walmart running a 6-day sale, Target doing a full week-long sale. And the battle isn't just in electronics anymore. It's particularly intense in everyday essentials, things like snack packs and household goods.
Interesting. It's fascinating to see how different companies responded to these tariff pressures during that period. Did some lean into discounts while others maybe pulled back?
Absolutely, there was a clear difference. We saw Apple, for instance, going surprisingly hard on discounts. Their AirPods were discounted even more aggressively in some cases than during their Black Friday deals last year.
Really? More than Black Friday.
Yeah. Which is quite something. You can contrast that sharply with Amazon's own devices, like their Echo speakers. The discounts there were, well, pretty soft, relatively speaking. It really highlights how different companies are strategizing and reacting based on their own supply chains, their profit margins, and their assessment of the tariff risks.
Okay, so we connect this back to the bigger picture.
Yeah.
What's the ultimate strategic goal behind these kinds of trade policies? It seems to be about much more than just balancing the books or import-export numbers.
It is indeed much more strategic than that. The core objective, particularly from the U.S. administration's perspective, is quite ambitious. It's for America to both design and physically build the technology infrastructure that will serve as the backbone of essentially the free world in the next century. This vision requires rebuilding critical industries at home and fundamentally rebalancing the global trade ecosystem. Take data centers, for example.
Yeah.
The AI revolution demands a tremendous amount of them. We're talking maybe 52 million square feet of data center space just in the U.S. pipeline by the end of 2024.
Wow.
That requires billions and billions of dollars worth of steel. The strategic desire is for that steel to be produced by American companies, using American workers, rather than relying heavily on what might be seen as artificially cheap imports.
That's a really compelling vision, but do we actually have the domestic talent and the manufacturing capability right now to pull off this kind of ambitious reshoring effort? Is the workforce ready?
Yes, I firmly believe the talent absolutely exists. Consider a place like Carnegie Mellon, for instance. It graduates more engineers than any other top university in the country. This engineering excellence isn't just ready for, say, national security roles, but also for commercial and defense industries. The primary challenge isn't really a lack of talent. It's more about incentivizing the economic and trade landscape. We need to create the right environment to allow that talent to flourish and be utilized effectively at scale right here at home.
Got it. It's about creating the right conditions. Okay, let's zoom out now to consumer tech and maybe a slightly different story. There's this company called Nothing. In a world that seems obsessed with more screens, more notifications, more everything, they seem to be trying to fundamentally change how we interact with our devices. It sounds almost like a philosophical shift.
It really is. Carl Pei, the CEO of Nothing, he has this core philosophy for their smartphone. It's designed to be used less. He talks about it being like a bicycle for the mind, meant for true productivity, not for endless doom scrolling, as he puts it. The idea is that while smartphones were originally intended to make us more productive, they've often kind of devolved into devices that just pull us away from focus. Nothing wants to try and reverse that trend.
Okay, but how does a phone actually achieve that? Making users use it less. That feels almost counterintuitive for a company selling phones.
It's about intentional design choices. The phone aims to help people stay more in focus by allowing you to be notified about only the really important things happening, without constantly needing to check your screen for every little ping. The goal is to break that addictive loop, where you pick up your phone to answer one quick message, and then almost unconsciously an hour later, you find yourself still scrolling through social media. It's about creating barriers to that unintentional usage.
Right, makes sense. And what about Nothing's market position, their growth? Is there actually a significant appetite for this kind of, well, contrarian philosophy in consumer tech?
Apparently, there absolutely is. Nothing is targeting a very distinct consumer base. They talk about young creatives and geeks who appreciate its unique, transparent design. It genuinely looks like nothing else on the market. And this niche strategy seems to be paying off handsomely. They've seen really remarkable growth, reportedly doubling their revenue this year to about $1 billion.
$1 billion, wow.
Yeah, up from north of $500 million last year. Their success kind of proves that a contrarian design philosophy, one that advocates for less usage, can actually capture a significant, maybe values-driven niche, even in an attention economy obsessed with more screen time.
That is significant growth for a relatively new player. Who are their users typically? And where are these devices actually being made? Any tariff issues there?
It's quite interesting, actually. For their earbuds, apparently more than half of the users are iPhone owners.
Really?
Yeah, and they're also seeing a notable number of iPhone users switching over to their Nothing phones as well, which is a pretty big deal in a market so dominated by Apple and Samsung. In terms of manufacturing, it's primarily in India right now, with some operations still in China, and they're planning a new site soon. Carl P. mentioned that the tariffs coming out of India are not that bad for them currently, which is definitely an advantage.
Okay. And finally, what's Nothing's strategy when it comes to AI? We've spent so much time talking about how critical AI is for the major players. Are they trying to build their own large language models like the big guys?
No, they're taking a different approach there too. They're not focused on building the giant LMs themselves. Instead, their focus is squarely on how to apply AI effectively in consumer tech. Carl Pei seems to firmly believe that to truly win in consumer AI, you need to own your own hardware. And for him, the smartphone is the crucial battleground.
Why the smartphone specifically?
Because, as he points out, it has the most scale, think about it, over 1.2 billion smartphones sold annually worldwide. And it also has the most depth in terms of understanding what we actually do on our phones every single day. Their goal seems to be leveraging AI to understand user habits and then automate smartphone use as much as possible for them, thereby freeing up user attention rather than demanding more of it. It's a very user-centric vision for AI, kind of flipping the usual script.
What an incredible range of topics we've covered today. From that intense AI investment race and the high-stakes battle for talent to Apple's very unique challenges, the sweeping impact of global trade, and even a company like Nothing trying to pioneer new philosophies in consumer hardware, it's really clear that all these threads are deeply interconnected, aren't they? Actively shaping not just the tech industry, but really our daily lives and the global economy.
Absolutely, and that's perhaps the key takeaway here. You should really consider how these seemingly disparate trends, the massive AI investments, the fierce talent wars, those evolving trade policies, and even the deliberate design philosophy behind maybe your next smartphone are all interwoven. They're not just isolated headlines. They are fundamentally redefining how technology is created, consumed, and even regulated. So maybe a final thought for you to consider. What aspect of this multifaceted tech revolution do you think will have the biggest, perhaps most unexpected impact on our lives in the next 5 years?
That's a great question to ponder. Thank you for joining us on this deep dive. We really encourage you to keep exploring these fascinating topics because the world of tech is always in motion and there's always more to learn and unpack. Until next time.